Go through question 9. Okay, I'll start explaining this. Again, not something on international finance, because the currency name is there, but nowhere the effect of exchange rates will come into picture. This problem ideally should have been done in share valuation. Ideally, I should have covered this as part of share valuation. The directors of wishes to make an equity issue to finance a 10 million expansion, which will have an NPV. If there is any NPV of a project, that will lead to increase in value of the company. To refinance an existing 6 million bonds in 5 years time. Refinance is technically called as bond refunding. Refinance is technically bond refunding. So we had done this bond refunding analysis when we were working out in valuation of bond. For early redemption, there is 3,50,000 penalty charges, technically called as prepayment penalty, which needs to be paid. It has also obtained approval to suspend the rights and make a 15 million placement of shares, which will be at, so they are going to make an issue of 15 million. What they are going to do with this 15 million is they will use 10 million for expansion. They want to refinance an existing 6 million loan, something is there. Some existing profits or existing cash flows could be there, but they are going to use 15 million and try to fund this. There is a cost associated with this, 4% of gross proceeds. Any surplus funds from issue will be invested in ideas which is currently yielding 10% per annum. If at all any surplus is still left over, they will put it in the some deposits which will be at 10%. Today's value of the shares is 7,000. It is basically 70 lakh shares. Today there are 70 lakh shares or 7 million shares. This is in thousands, and the price of a share is 2. So it's basically 7 million share into 2 is today's value or today's net worth. This will go up by 15 million because I'm making a new issue. Whatever new issue, this is like you go back to your understanding of mutual funds. When you issue new units, your net worth will go up. On top of that, if the project generates some positive NPV, further there will be an improvement. So I'm going to have the 7 million into 2, and I'll see what is going to lead to increase in the net worth, what is going to lead to decrease in net worth. What can lead to decrease in net worth is that penalty charges, 3,50,000. That will lead to decrease in net worth. What can also decline is flotation cost of 4%. All of this is going to lead to dip in the net worth of the company. It is further presumed that stock market is semi-strong form efficient and no information from the issue has been made. This you will learn, this is basically a theory area. There is markets can be strong, semi-strong or weak. Basically what is strong, semi-strong and weak is if everybody has an understanding of all publicly available information and able to understand how that information will affect a company, then it's a strong form of market efficiency, which is very rare because a lot of people invest in a company without even knowing what the company does. They don't understand it, but still they end up investing. So strong form of market efficiency is one where people have absolute amount of understanding. Weak form is no major understanding of the publicly available information. Semi strong is somewhere in between, not going to somewhere impact in my valuation. But basic logic is semi strong is a scenario where you are able to have some understanding of the publicly available information and incorporate that in the share price. You are required to calculate expected share price once full details of the placement unto which the finance is to be put are announced. So the company is going to come and say, make an announcement saying that we are making a fresh issue of 15 million and this is what we are going to do. Moment this is done, what semi strong or a strong form of market would mean is that everybody understands that this will give so much of NPV. If this gives so much of NPV, this is going to be the final value. So if everybody understands it properly, at what value this company is going to. So I'm going to use something of mutual funds, which is movement in net worth, something of bond refunding, something of share valuation. Again, currency can be ignored in the question. It talked about dollars, but it could have been any currency, because again the exchange rate is not coming into picture. Working note 1, computation of expected share price. Particulars calculation amount. Point number 1, existing net worth. We'll do this calculation in thousands. Existing net worth. How many shares are there currently? How many thousand shares are there? 7,000. And what is the price? 2. So currently I have 14,000, or technically 14 million is the value. Currently it's 14,000 thousands or 14 millions. Existing net worth is 14 million. How much is the fresh issue I'm making? How much? 15 million, 15,000, fresh issue, 15 million. This will lead to net worth improvement. 15 million is going to lead to net worth improvement. Fresh issue 15 million. But to make this fresh issue, I have to incur some cost. What's the cost? How much is that? 4%, less flotation cost. So my net worth will not exactly move by 15 million, it will move up only by 14.4 million. This is concept which is done in chapter of mutual funds. This is what I had done in mutual funds chapter, understanding the net worth movement. There's also, which, yeah, gross is 15 million. Point 4, no. Flotation cost will be 4% of the gross sale proceeds. So into 4 directly, no. That will be to calculate number of shares. That will be used to calculate number of shares. Next, NPV of new project. See, this 15 million is put for 2 uses. One is to do a new project and second is to do a bond refunding. Both can have positive NPV. One can have positive, one can have negative. The project will give you positive NPV. How much? So 2,200. Project will give me 2,200. And balance funds is utilized for what purpose? Bond refunding, NPV of bond refunding. So new project will give me 2,200 and balance is on bond refunding. balance is on bond refunding. So what am I going to get out of bond refunding needs to be seen now. So existing net worth 14,000, fresh issue 15,000, flotation cost is there, NPV of new project is there, NPV of bond refunding needs to be calculated. Now listen, uh, is there any call premium or anything mentioned in the question? Okay, there's a penalty charges. Apart from that, anything else is mentioned? Okay, it is going to be to refinance an existing how much? 6 million bonds. So now listen. Year, cash flow, PVF, DCF. Year 0, I will have to pay 6,350. 6 million and another 350. 6 million and another 350. 6 million needs to be paid for this and 350. I'm not making a new issue and all. I'm not making any new issue. Whereas this is technically not exactly a bond replacement. I refund the bond, but I don't issue any new bonds. I'm going to issue equity shares. So day 0, company has to have an outflow of 6,350. The benefit of this is you need not pay interest for 5 years. You need not pay interest for 5 years. At what rate the interest was paid on the bond? 15%. So every year I save this. On top of that, at the end of year 5, I need not pay the 6,000. At the end of year 5, I need not pay this 6,000. So I'm not going to pay 6,000 at the end of year 5. I'm not going to pay 900 for 5 years. By today giving 6,350. Today I'll give 6,350 and save on 900 for 5 years and 6,000 at the end of 5th year. Because why I'm refunding, it's at 15% rate of interest. So maybe on the cost, more on the cost side. So I'm refunding this bond. By refunding, I may get some positive NPV, some negative NPV. It can be anything. So year 0, there will be an outflow of 6,350. When I say outflow, from the company's pocket, 6,350 has to go out to the bond holders. 6,000 is towards redemption, 350 is through prepayment penalty. 1 to 5 you will save 900. At the end of year 5 you will save 6,000. Calculate the NPV of this. Calculate the NPV of this. Your discounting will happen at 10%. That's the cost of capital of the company. So this helps the company in saving some 787,000. Some 787,000 they end up saving because of this. I've raised this money and used for 2 purposes. One purpose gave me an NPV of 2.2 million. This purpose gives me an NPV of 787.9. Any doubts on 787.9? Initially I pay 6350, I save 900 for 5 years and then I save 6000. Now, if I just look at the question, we have given effect to the first transaction, which is this refinance. This part is taken care of, 15 million, 4% of gross sale proceeds. This information is of no use. Debenture price is 103, that doesn't impact my solution. I am required to calculate only the share price. So, finally, total net worth, number of shares, and share price. Total net worth, number of shares, the net worth post doing this exercise will become from 14,000 it goes up to 31,387, but number of shares will also go up. The share price may go up, come down depending on the issue price. Any doubts on 31,387? How many existing shares are there? How many new shares will be issued? 15 million divided by 0.5, which is 30,000. And my share price is going to come down drastically. The reason for that is my new issue has been made at 0.5, whereas the existing share price itself is 2 rupees. The existing share price is 2 rupees. There is no logic of making that new issue at 0.5. So, share price comes down drastically because the new issue has been made at a significantly lower price. Because of that, share price has crashed. Now, I am almost done with this chapter. There is one more problem which I will again send it as a video, because next class I want to start with derivatives. Do not miss the first session again. Derivatives, initial set of sessions you miss it, you will find it difficult later on. One area where I have not got that comfort whether you are comfortable is this area, international capital budgeting. I am not that convinced with it. Other areas I found somewhere that confidence is there. This area, please do the homework problems. Get back to me in case you are struggling. Please get back to me. We will end with this then.